Good morning, everybody. It's Friday at last. Welcome to the Flow Show. Seems to have been a pretty rapid week this week, as they all seem to be flying by. Morning, Stel. How you doing, mate?
Good morning, TGIF. What's it? Rapid week? It felt like a month to me. All these talks about the debt ceiling over and over and over again. No, it's all good. It's all good. How are you, my friend?
Yeah, all good, mate. All good, mate. Looking forward to the weekend. Oh,
When's
dear,
the football final? West
mate.
Ham.
June the 8th.
Oh,
If anyone hears of any spare tickets, I'm in the market.
nice.
Rare as rocking horse pup at the moment. But I'm keeping my fingers crossed. So anyone of our Flow Show members living in Prague who can secure me a ticket, I'll play with beers all during the week when I get over there.
Nice.
But, yeah, until then, I shall just have to wait and see what happens.
Yeah.
Right, so I've got 100 debt ceiling headlines to get through today, which will please Stel immensely, no doubt. No, but you're all lucky. I've picked through the choice comments, so we'll get through the ones that I think matter to us in our trading. We shall kick off in China as we do, and some warning shots have been fired this morning, proper warning shots this time. Firstly, they set the midpoint at 7.0760, just as we were up here in the 708, 709s. That was versus the 7.0529 yesterday. So still happy to fix it higher, not put the brakes on there. But then early this morning in the UK European morning, it was out that China major state banks were seen selling dollars in the onshore spot market. That caused this bit of a blip this morning down here, taking us all the way down to the 705s. Doesn't mean we're at the end of this rally. As you can see, we've already sprung back quite a bit, but it is yet just another step that they can do, officials can do, if anything, just to put the brakes on this move. It could be they're selling for other reasons, not just to support the currency. They have bonds maturing and various other measures that pop up, repos and that sort of stuff during the week. So it could just be part and parcel of that. But if it develops into something more, then we could find a more significant top going in. As I say, it may have just put the brakes on. It may have got people who are long, like myself, just getting a bit more wary about the upside. As soon as I saw that headline this morning when I woke up, I chopped more of my position at 7.07, and I've pulled my stop up behind it as well. So we'll need to see what they do from here on in. Over to Japan, and Ueda was out yesterday. You remember yesterday morning we spoke about some government economists talking about how they could end YCC maybe this year. Well, Ueda came out and said that shortening the duration of the bond yield that they target to the 5-year zone from the 10-year zone would be among the options if it were to tweak YCC in the future. It could tweak YCC if the balance between the benefits and costs of policy shifts. It is possible to keep 5-year bond yield stable and low even by targeting the 10-year yield, as long as the shape of the yield curve is an upward slope. He then countered that somewhat by saying that the BOJ must avoid tightening monetary policy prematurely. So we know that the YCC is a tool by which they could start tinkering with things. This is, again, another bit of putting some options out on the table, but keeping the cautionary tone about when they might move and how they might not go prematurely. It would be a sort of minor piece of tightening. It would be a decent shift, but just targeting the 5-year instead of the more than the 10-year just gives tightening a bit of rope, if you like. It's not letting the whole thing off the leash. It's just another little step that they can take towards coming out this easing phase. Nevertheless, it did hit dollar yen at the time, right in there, I think. think it's where's the time? No, where was it? Oh, it was over here. So it was just around that data time that we got that, just before the data, if I recall, and then we got the US data and we saw a bounce, and then we went through the 140s. But you can see there we are still prepared to move on things that the Bank of Japan come out and say. We're just not fully in that zone yet, and all other things going on. He also said that Japan's consumer inflation is likely to slow ahead, but if this projection proves wrong, we will act swiftly. So still keeping the mantra that they expect inflation to drop later on this year, and they may be proved right. Where are we going? I've lost my calendar. Where's my calendar gone? Oh, there we go. No, there we go. So yesterday we got, or overnight, we got some CPI data, Tokyo CPI out of Japan, and it was softer than expected and softer than last month. Although one of the measures, X food, this, that, and the other, and everything came in a little bit high. It's not on that chart, so it's not on this page here, but it did come in higher at 3.9%, one of the highest in I think 40 years. But the main numbers did come in a little bit softer. We have seen this before, where CPI went up, then had a little pullback, then continued on higher. So the next readings are going to be important. We may expect the next main CPI numbers to come in perhaps a little bit softer as well. But then we see the month after, is it going to start trending lower, or is it going to carry on back higher? But for now, it's falling into the path of what UAID is saying. There was also some PPI numbers out as well. And again, I don't know why they're not shown on this. Let's have a look back. No, not shown on this. But PPI for services came in as last month at 1.6% year on year. So no signs of PPI numbers for that sector dropping just yet. Finance Minister Suzuki was out saying he's closely watching FX moves. That'll be on the back of this run that we've had pretty much throughout May, or at least towards the midpoint of May. We've done a decent 600 pips, 550 pips so far. We're not in intervention territory, so don't even start thinking about that. That only comes into play if we are moving in 200-300 pip clips in a day or in a session or something like that. Over a long period of time like this, it's not going to be such a factor. But Suzuki thought he'd get some comments out saying closely watching FX, and FX rate should be set by the market based on fundamentals. Now, something that might come into the inflation pot later on is that Japan is going to be winding down its gasoline subsidy from June, and it will end in September. So they've been doing their bit for the population by putting in subsidies for fuel and stuff. That's going to be dropping out later. If prices remain high, then that's going to maybe give a secondary kick to inflation numbers in that period. But as we've seen from oil recently, it's not doing an awful lot after coming down quite significantly. We're just waffling around in the same old levels, really. So just a bit of an indication that they were putting this in based on, you know, when oil was back here and the feed through that you get from oil when it was higher up last year, because it does take, you know, 3, 6, 9 months for all those sort of prices to feed through. We've been sitting down here for quite a while now, so that means that energy prices have come down and they will feed through into inflation numbers as well. So that could be a bit of a backstop for the Bank of Japan and their calls of inflation coming down. Over to Australia, and retail sales for the month came in flat. Bit disappointing there, 0.3 expected month on month. The RBNZ Assistant Governor Silk said that rates need to stay on hold for an extended period, and watching if markets price rate cuts too soon, highlighting the battle to come for central banks who hit their peak, and then we'll have to spend time convincing the markets that they're going to keep them high, and the market's going to be pushing them as to when they start cutting. That's going to be the trade in the second half of this year. Over to South Africa, and for all you Rand watchers, and I know there's quite a few of you, they hiked 50 pips to 8.25 as expected, and announced that policy is restrictive at its current level. We can see there we did have a blow up over these highs. It took a while to happen, so I'm not suggesting it was all SARB led, but we did get a break of these prior highs. It shot up, and it's coming down a bit now. Again, I think the dollar's just being influenced by other things, but them going on hold potentially now could mean that we get further upside here at least, but that magic 20 is still not too far away. Coming over to the UK and retail sales this morning, coming in, you could call it a bit mixed really. We were up on the month, headline sales up 0.5% versus 0.4% expected, and jumping from the minus 1.2 prior. Core sales, and there's several measures, ex fuel, ex this, ex that, also showing positive at 0.8%, and not down as much on the year. These have been a bit up and down, up and down, up and down over the last few months. There's no real trend appearing in these. So really we're just moving between the goalposts, if you like, between 1 month being good, 1 month being bad. No overall trend showing. Not too much of a move in the pound this morning. However, based on everything that's gone on since the CPI, according to OIS, which is overnight interest rate swaps, the OIS curve, the market is now fully pricing in a peak interest rate at 5.5%. And BOE's Haskell was out yesterday adding a bit to that, saying further increases in the bank rate cannot be ruled out. He prefers to lean against the risk of the inflation momentum. And as difficult as our current circumstances are, embedded inflation would be worse. It's prudent to reduce the focus we place on forecasts of the medium term and put more weight on the near-term data. It's another bit of an admittance that their forecasts aren't worth the paper they're written on, as we've been speaking about this week. He is one of the hawkish members of the MPC, so no surprise to see those comments there. Still, a lot of the market are coming around to the fact that the BOE is going to have to go higher. Is that a surprise to you?
Well, listen, as Steve would say.
You know what? I'm waiting for him. Sorry, I'm waiting for him to say, because he also likes to say at the end of the day, and I'm waiting to say, you know what happens at the end of the day, and I'm going to jump in and say it gets dark.
True. So the Bank of England, well, we have said repeatedly that with inflation being the stickiest out of the major central banks, the UK is the more in danger of having to go higher, and I think we're seeing that in what the market's pricing. And this is one of the main reasons why I've been saying for weeks now that I think the pound is probably going to do better than the other major currencies for the rest of the year. What do I think the MPC is going to do, Bank of England? Well, they have to move rates a little bit higher. The problem I have with them is that they always try to find an excuse to be dovish. They've always done that. Ever since I can remember, for the last 20 years that I've been trading, 20 plus years. So that's a problem I have. Theoretically, they should be doing more until the rate of change of inflation to the downside starts becoming obvious and starts becoming bigger, like in the US. We were seeing 0.5% or plus steps lower every reading. We've gone from 9-point-something% to 5%, below 5%, and we're going to go below that as well. So I think the Bank of England has to keep going, and but will they deliver? That's a different story. And the other thing I want to add, and I know you asked about the Bank of England, but I have to say about the Fed as well, talking about rate expectations. If you look at Fed Fund Futures, which is the equivalent, the OISs for the dollar, we are now pricing a hike not by the next meeting, but we are pricing it by August. So when's the next meeting? There's one in June and one in August, right? If I'm not mistaken. Anyway, I have to check again. But we are pricing one hike by August, but then one cut by December. So we have been saying for a long time that the 75 plus basis points of cuts that were priced in for this year, they have to be taken out, because the Fed is telling us repeatedly they're not going to cut, and the market is also not giving us enough bad data to warrant that. Having said that, and this is what we're seeing, right? We're taking those rate cuts out. We've only left one, but then again, we're pricing a hike in between. So net, if you look at May Fed Fund futures and December, they have like 5 basis points difference. So they're basic flat curve. So the question now becomes same with the Bank of England. Do they hike, and then how long do they stay there? And I think we're pricing now a hike for both of them, with the Fed being more probable of staying there and starting to cut. That might be fair. I think the Fed is a lot closer to the peak than the Bank of England is. But the market is going to be pricing and repricing and overpricing and underpricing, and it's just going to keep trying to anticipate the pivots. And I think at the end of the day, it's going to realize it's not going to be a pivot yet. It's just going to be a pause and flat line for a little bit. That's what I think.
Yeah, no, I agree with that, mate. I agree with that. The Fed, I still think a pause is probably predicated on what happens with this debt stuff, which is edging closer, I think, to a resolution. But we'll get into those headlines in a moment. Just to chew over some of the rest. ECB's Nagel said the ECB will continue tightening to overcome high inflation. ECB's Villeroy is a bit more fence-sitting. It says ECB should reach its peak in the next 3 meetings. ECB's Not, who's on the hawkish side, says we need rate hikes in June, July, and he's open-minded on September. He says most of the tightening impact is still in the pipeline, the ECB to hold rates at peak for a significant time, and there's no sign that underlying inflation is abating. ECB's Wojcik said it's questionable we will be able to get inflation to 2% in the next 2 years. And ECB's Lane says economic growth will be subdued this year. Now, we'll be keeping half an eye on the Riksbank because they've been moaning and groaning about the level of the crown, and Riksbank's Bremen said we could increase bond sales if Swiss krona weakens. So no real move there on those headlines, but the recent comments have been that they've been pretty powerless to do anything about it. But now they threatened that they could do more bond sales to do that. Euro Swiss is the biggest mover, probably based on those headlines there. We've seen a big drop off there. So a bit of a warning shot from the Riksbank if we continue to see this running higher. Data out of the US yesterday. Just get a shot of that quickly. GDP numbers and jobless claims. Now, I wasn't expecting much of a move yesterday on those numbers, unless there was a big variation. We got a decent uplift in GDP, moving to 1.3% from the prior and expected 1.1%. So a decent improvement there. But the jobless claims took all the highlights, coming in at 229K versus 250 expected. So was expected to keep climbing. It came right down. The 4-week average was expected to climb, and it came in pretty much unchanged, although that number was revised previously. So again, the jobs market not showing any big worries there, although we have to remember we did have a couple of weeks ago some seasonal impact in that caused a bit of a jump, so it could just be a further washout. Either way, we're back into levels, or still at levels, that are not showing any red flags from the jobs market. And we saw a bit of a rally on the dollar on both those numbers there. Fed's Collins came out and said we may be at or near the point it can pause rate hikes. So still a bit up in the air between the Fed members what's going to happen in June. I still say a hike's coming if we get over this debt stuff. And speaking of the debt stuff, so here we go.
Right. Well, before that, just to mention that we do have next week payrolls, jolts, and then we get CPI before the interest rate decision. So the big numbers coming up first. Yeah. But yes, absolutely, the debt ceiling stuff is at the center of attention now.
Yeah, and we get what did we get to? Yeah, I think we do get another CPI. So we get 2 CPIs before the next FOMC. Obviously, we just had one, and we're going to get another one before the FOMC. So there'll be 2 lots of data in there. Going to be a busy week next week. I think we get the ISMs and everything as well. So
yes,
we'll have a look at it. I'm not going to look at it now. We'll have a look at it next week. So all the gap stuff, all the debt ceiling stuff. Largely, it's been noted that both sides see the gap closing on this spending level. That seems to be the main sticking point at the moment, and they're said to be less than 70 billion apart in those negotiations. McCarthy has said that he has instructed negotiators to work 24 hours a day to get a debt ceiling deal, and a deal could happen at any time. A lot of the government has gone on the long weekend, but negotiators are apparently going to still be working if need be. He was asked about what happens if things shut down, and about Americans who rely on government payments, should they make backup plans. He says he wouldn't worry about that. So that's an indication that, we are close to a deal when they're not going to let it hit the limit where stuff has to shut down. Can't rule it out still, but these sort of comments, this sort of rhetoric has been coming out from both sides. What also is important is that apparently the White House and GOP have said to discuss lifting the debt cap through 2024, which means that we can potentially rule out a short-term can kick, i.e. one just to September. So if we get a deal that takes us through 2024, that will be the more hawkish outcome or bullish outcome, and the market can then shake its legs, get rid of everything it's been trading over this, and not worry about it for a couple of years. Now, there's no deal yet, but the sides are predicting that votes may happen Tuesday night or Wednesday night. One of the things that may happen is that we may trip over the deadline day, which is potentially June the 1st, purely technically because they need to get all these votes, all the paperwork tied up and all the votes through the houses, so on and so forth, which will take time. But if we get before the weekend or, early next week, the confirmation that there is a deal on the table ready to be signed and voted for, it won't matter if we trip through that June 1st date. The market will be happy that we've got a deal, it's going to go through, and we can move on. So don't worry if you hear in headlines people still getting jumpy about this June 1st date. If a deal is on the table, it won't matter. Coming across to just some geopolitics, and TASS reported Belarus President Lukashenko saying that the transfer of non-strategic nuclear weapons from Russia to Belarus has already started. This is part of the rising rhetoric that Russia has put in with regards to Western elements, Western countries putting their influence into what's going on in Ukraine, and this incursion into Belgorod, I think it's pronounced. That was Russia saying that, as we heard yesterday, that does step up the possible use of nukes as a response. Moving nukes to Belarus has been something the Russians have been looking at, and they've been building facilities there the last few months. But now it seems that those nukes are on the move, so not a good step on that front. Right, that's all I've got on the headlines. Stel, you got anything that I've missed or you want to throw up?
I'm feeling like I want to throw up. No, I'm kidding. No, not really. It's the main event I think overnight was the kind of positive headlines about the debt ceiling. And let's face it, they're going to do it. They're going to agree. And, they've narrowed down their differences, blah, 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 haven't found an accord, still working on it. Yeah, okay, they're gonna figure it out. Well, I don't have any other headlines to point out. I just think that's the main one. And still going to be driving markets, which have been relatively resilient, but we'll talk about markets whenever
Yeah,
you're ready. Yeah.
yeah, definitely. I mean, I'm think I'm moving to 90-10 that we get this sorted out now, which has shifted this week. I was 70-30 Wednesday, 80-20 yesterday, and now I'm 90-10 that we get a deal.
Yeah, the question is how should I put it? Is it a short-term deal, or is it, where you kick the can for 2 years? If that happens, then the markets are going to love it. If it's a very short-term solution, the market's going to have a little relief rally, but I don't think it's going to be very long-lasting. But if they do a 2-year deal, then that's it. We keep going.
Yeah, I think I'm leaning towards that it's going to be a long-term deal, because if they do kick it through 2024, that gets them over the election. They don't want to be doing this in 3 months' time. Over again. So I think that the prospect of a longer-term deal is on the table. Wouldn't rule out something like they take a short-term deal if they can't get all the paperwork done. They might kick it to September while they put everything through the houses if they need to. So I wouldn't rule that out. I think it's a low chance, but I think it's a good chance we get a long-term deal. And it's going to be interesting because I'm getting really confused about what the market is trading right now. Because even while we were getting you could say the dollar's been rising, the yields have been rising on the back of no deal, perhaps, but then we get the good news and it keeps going. So is the market really buying dollars on a prospect of a deal being done? I look at the 1 month. 1 month has been a good gauge because that has really reflected what the market's been thinking, particularly regarding the US potentially defaulting. Let's call it that. And that's the premium in the yield there, where we got that jump on that auction a couple of weeks ago. It's come down. We're up at 6%. It's come down, but it hasn't really come down a lot. I should point out this is not a very liquid market, so I'm just using it as a bit of a price gauge, sentiment gauge more than anything else. So I don't know what the dollar does. I mean, it was interesting that the dollar rallied on the data and the dollar yen dropped on the UADA headlines. That's how you would expect it to work. But I don't know. I don't know what this does if we get a confirmation. I don't know if the dollar rallies or if it sells off. I don't know if yields rally or if they sell off. Is it clear in your mind? I know you've got your idea, but is it 100% clear in your mind?
Of course not. No, as simple as that. Simple as that. No, it's not. I have nothing more to add. Sorry.
Thanks for that. So rule in the dark. Answers on the postcard, please. Anyone got any ideas that you can teach us? Put it in the comments on the chat here. We're all in the dark at the moment. But yeah. So anyway, we took out the barriers in dollar yen 140. It looked like it was holding. I got Steve says Gavin. No, we've only got an hour in this show, so you can ask him on face, Gavin. I'll leave it to that and let Dale deal with him. So yeah, we got this break of the 140 barrier. I did nick into some shorts into that, and I wasn't too keen on them. When I trade things like barriers and big figures that we haven't traded for a while, I like to get a quick run up to the level and then a hold and then a pull back if that's what it's going to do. And I think it sort of did that when we were up at the 80s in this sort of area. I think that was the main barrier defense. So that's where we got the decent pullbacks. So when we got up here, I wasn't too keen about those positions being put on. but I thought the level's a level, so I'm going to get in it. So I was short at 90 and 95. We got the break, and fortunately, I had my stop at 140.25, and we got to 140.22.
Nice.
So managed to. I would have been pissed if it had got tipped at the top, and I've had it done enough. We've all had that happen to us. We know how it works. Shit happens, but this time I managed to stay in the trade, and I've taken some off at 70 when it pulled back. I had an order in for half the trade at 70, and I got some off at 50 in this little move down here. So
you know what, Ryan? Sorry, carry on. I just wanted to add something afterwards. Carry on.
No, go on, mate.
I was just going to say, I don't know if it's the same with you, but for me, over the past, I don't know, 2-3 years, I find myself putting much wider stops and trading smaller size because of the way things have been going. It used to be pretty clean, the price action. Now you get many more kind of stop runs left, right, and center, and then reversing again. It's like and I found myself getting chopped up so many times that I said, right, okay, bigger stops and smaller size, and it seems to be working a little bit better.
No, I agree with you. I mean, I used to, on things like that, I would usually have something like a 15 pip, 20 pip stop. But you're right, it has seemed to extended these things, which is when I went for 25. You've got to draw the line somewhere. You could go for 30, 40 pips, 50 pips, but then you're trying to, I'm trying to play the 140 level, and I'm trying to scalp 20, 30 pips of it. I don't want a 40, 50 pip stop above, because that just makes the risk reward crap. But yeah, you're right. It does seem that the extensions, let's call them that, be them stop runs or whatever, are going a bit further. So it is wise to, if you're going to go with a wider stop, reduce your trade size. What I would say to traders is, if just trading generally and you find your stops are getting hit a lot before the price then reverses your way, that is another indicator, exactly what Stel's talking about. The market is going more than you're risking, so you have to adjust to that. So you reduce your trade size, and then you can go with a wider stop. It means you can risk exactly the same amount as you were originally, but now you're hopefully getting yourself out those trouble spots where you're getting stopped and then the market's going your way. I'd rather risk the same amount and make less than risk the amount and lose more, if you get my drift. So it's a good point you make, Stel, and that's something all traders have to look at.
I have my moments.
You always have. You have lots of moments, mate. You have lots of moments. So yeah, that's something for traders to know. If you find you're getting flipped on a lot of trades, it's happening often, you need to change something. You need to go over the trades, find out if you were trading with 20 pip stops and you keep getting triggered, well, reduce your trade size a bit and go for a 25 pip stop and see if that helps. It's all about tinkering around the edges sometimes, as long as you don't let it get out of control. But for dollar yen, we're back below 140. So it does look like a typical bit of a barrier stop flush. Immediately after 140.10, we couldn't get back to those highs. We had 2 attempts at that. Market said, no, that's enough. Now we're back below 140. It means we're going to have to do all the hard work again if we're going to break higher. So this one's going to be interesting to watch if we get a debt resolution headline coming out today. If that's the case and we can't break up back above these highs, or if we don't even have an attempt at these highs, that will tell us what we're trading at the moment. And I'm on the same boat as you, Stel, and I think Blake as well, that if we do see a rally on the debt ceiling stuff, that might be something to look at countering. Although I would say the data, once again, is looking pretty good at the moment from the US. So, we're going to switch straight back into trading the Fed again. Then if they're going for a hike in June, maybe one other or 2 others, then maybe the dollar isn't in for suffering just yet. So just get over one hump and then we can look at the other humps. That's what I say. So get over this debt crap and then we can see what the market wants to do thereafter.
Yeah, absolutely.
Yeah. Euro dollar. Been looking at the 107. I jumped in at 107.10, had another bid at 107.05 that went unfilled. We've had a bounce. It's looking a bit dead cattish though at the moment. What I want to see is either a break back above 107.60 or a move down back near 107.10s that holds. If we make a new low down to that 107, I may add back into my position because this is still the main level down at 107. But you know, unless we get back above 107.60, it's going to keep the bearish pressure on, and then we may be suffering worse. So again, this is going to need to be looked at carefully. It's a pretty similar picture across a lot of dollar pairs. You know, cable the same, down into this 50 fib, 123 big figure, bit of a bounce, bit of a stronger bounce. That's what cable likes to do. For me, it's up towards 123, 80, 90, 124. That's the marker for a bounce. If we can't get above there, it keeps this trend in play, and then we see what happens at this 123 again. Aussie dollar, just to look at another one. Again, another bounce. We were looking at this 65.20. We've got above it. The big figure held for a little bit. My stronger area was down towards 80.90, and we held down there. We are trying to, you know, get above the 20, but its number is really this 45, 47.50 area. Unless we get above there, it keeps the bearish momentum in play. So if you're in some of these trades, if you caught the knife off the bottom here, I tried to catch the knife at 20s in this, got stopped out, but I also got rid of more of my short in that move. I've still got a little bit left of my short. Happy to hold that for now because the trend is still my friend. But if you bought off the bottom here, then you need to be thinking about taking some pips off, because if we can't get above this area here, you know, it keeps the momentum in play, and perhaps we're going to have a further move south. If you want to look for strong signs of a bottom, then you want to test back down towards these lows, maybe the 65 holding. If the 65 holds, it will tell you that these buyers down here at 90s are parking the bus at 65. Then you start to maybe think about getting a bigger bounce, because the market is telling you, right, we're not going any lower. This is exactly what I did. I want to take you back when I bought Aussie dollar down here into the 60s. We made a low, and then we held above that low for an extended period of time. That's the signal you're looking for when you want to try and pick bottoms. Here, you had a signal where there was plenty of bottoms coming in play, and it was holding. It made a low, it held, then it broke. That's telling you we're not done yet. This is telling you hold, 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 move up above the key level. Now you've got something. So this is a trade I got in last year that I ran all the way up. So you look for the price action. This is what tells you where the bottoms are in. It's not this candle. Let's see if I can zoom that in. It's not the first candle. It's the second, it's the third, and then it's the fourth. And it's holding the key level that it didn't hold on the way down. So what's that? The 62 handle. Went through it, went through it, held it. Those are the signals you want to look for. So you can look at those, the same thing here. If you look at it on a daily basis, low, another low. So we've held this level once, call it 64.85, okay? If you get another candle that doesn't quite get as low, holds a number, look for that build up of price action. The longer you get that build up of price action holding support, the more conviction you have to catch the knife and then look for a move back up. Because if it ain't going down, the only other thing it can do is go up, which is exactly what happened here. So I don't know what you guys and girls are doing. Let me know in the chat what you're looking at, what you're doing. Have you been catching the knives? Are you still short? What's your view on these sorts of pairs? Mike, you want to have a look at Euro Sterling? This one's a bit of a snore fest still. We've had moves up towards the 87, up towards these highs, can't get through. I'll tell you what, if I spent my day just jobbing this between 86.70 and 87.10, I could probably retire at the end of the week. But we came down yesterday, we've held it, we couldn't get down to those lows as I mentioned. That gives you the conviction that perhaps we are finding a bit of a bottom down here. So much like I was just showing with the Aussie dollar, We've had a move down all the way from the 88s, but we're having a period where we can't get and hold significantly below 86.70. Price action speaks for itself. However, we're not breaking the upside. Now, this one can spend ages going sideways. So really, if you're going to be trading, if you're long down here, you want to get that break. The longer we go without a break, the more chance we have of hitting the downside. The longer we go hitting the downside without getting through, the more chance we have of a break upside. I think I'm more edging towards looking at maybe sticking a buy stop now in at around 87.20, just if we do get a break up. And I may consider going with a break of a confirmation short down here, 86 below 86.70 if we get another one. But it's a bit wishy-washy under here. I'm still core long, but I'm more than happy to try a separate trade or reverse it if it looks like this is going to break properly. So we've come through the Bank of England CPI, we've come through the BOE, we've come through Bailey, we've come through all the speakers, and we're still in this zone. So fundamentally, the market is happy with the levels it's at the moment. It's going to need something different to change that. Still, you got anything you want me to look at, or you want to look at in particular before I look at some other currencies?
Not really, no. It's a bit of a sideways, apart from metals, which are doing well today. But then again, they were doing pretty badly yesterday. It's a relatively quiet day so far.
Yeah,
go on.
As I say, a bit of a little fake out through this 50 area, wasn't it?
Yeah, I still think for choice we're probably going lower, but debt ceiling gets resolved. I think everything rallies. But no, I was gonna say you see Cathy Wood getting out of Nvidia longs just before this big rally. I mean, seriously, I would never ever trust her with any of my money. Anyway, yeah.
Someone put a chart up of that. Yes, yeah. I just caught on Twitter where they mapped her holdings of Nvidia, where she was buying, selling, along with the price, and she was literally, buying the highs and selling the lows. It was unbelievable.
Yeah.
But, oh well, we can't all be winners, can we?
Yeah.
But yeah, gold. So it broke through. I know Dale was looking at this 50 area. A lot of people looking at this 50 area. Held the next band of support. We're not breaking yet. Look at the fibs. That's always my marker for whether trends are breaking. And this is a significant move since October, and we're not even close to the 38.2. So this could well be just a bit of a refresh of the trend, which is what they like to do. Can we get all the way back up here? It's going to take a bit of work, but we remain in the trend unless we start getting through some of these fibs for now. Euro NOK. I was looking this yesterday. I was thinking about having a little play maybe off the 83s, 84s, just up here when we were trading up around here. But it broke above, so I held off, but it has come back a bit. Again, it looks like it might be developing or trying to develop in a bit of a top. We obviously had that move to 192, which was a decent extension of where we'd been previously around these 1180s. What's your thoughts on this? Are you interested in getting back in yet, or you want to see it back up?
Yes, I am, but I haven't done anything yet. I'm looking at dollar Norway because that's basically at previous highs. We broke above yesterday, but we are now there 1101-ish. So yeah. I am looking at both dollar NOK and euro Norway, and I want to short both again, but I haven't pulled the trigger now. So as Steve would say, I'm looking for more confirmation.
Yeah.
And but yeah, it's definitely a currency that I really want to own, the kroner, but it's very frustrating because the central bank keeps selling the crap out of it.
Yeah, well, next week, the 31st, we get their next FX report, which is where they'll tell us whether they're pausing, slowing, what they're doing. So that's one to keep an eye on. The only thing what I don't like about dollar NOK is that we broke the prior high last year.
Yes.
That I don't like.
But it could be a false breakout, right? I mean, we're still waiting to see what happens, but I wanted to make a new, basically, if we close on a daily basis below, let's say 1080, then that has been a false breakout, and that I'm going to start pushing into that. But I'm not convinced yet.
Yeah, I mean, it's even looking like it's trying to hold the break at the moment.
Yeah,
and I don't, you compare that to Euro knock, which is, it made its high, but it hasn't got back to that high. We can take this spike mess out the equation. Crazy times, but just based on this price action, you've got something to lean against. Up here at this prior high, if you want to think about shorts, that's the level you want to look at, and you don't need to throw too much money at it. If it breaks above that high, then we're probably off and running again. So if you're looking at this one as well, I know K-Man's probably still watching it while he's on holiday, even though he shouldn't be. Just keep an eye on what's going on up here. If we can't get above this sort of 86 back into 1190, perhaps. I say I was looking at maybe a short yesterday on this level, but it made that fresh high. That's the sort of area you want to be looking at.
Well, one thing, Ryan, one thing I want to address is a question by a friend Ali saying, tell me about risk reward ratio, how it works, etc. for money management. The thing to be aware is that the hit rate that you can have with your trades, actually, no, let me put it another way. When I first started trading at a bank, one of the guy who basically was my mentor, very, very successful guy, says to me, what do you think the hit rate is on trades? What do you think my hit rate? He says, I said, well, I thought, 80%, you're right. No, he goes 50-50. And I was shocked. And he said, the average person who tries to trade as an amateur is below 50-50. A good professional is 50-50, maybe 60-40, a really good professional. So the main point is to make it work when you're right and to cut it short when you're wrong. So that's why, personally, when I put the risk reward, when I put my trades on, my risk reward usually is 3-1. I actually try to have higher than 3-1, but you have to be, obviously with a 50-50 hit rate, you have to be more than 1-to-1 risk reward, because otherwise, statistically, you're not really going to make money. Yeah. So it will obviously vary if you're a scalp trader, a swing trader, or a macro trader, or whatever you are. But I think in general, the much shorter term traders have tighter risk reward ratios. You see people going 1.5-to-1 or something like that. But you still have to have a good risk reward ratio, which means you have to be more selective on your trades. That's what I am trying to do. That's why you don't hear me saying, oh, I'm in this, I'm out of this, I'm in that. People do that, of course. That's not me. So I tend to put at least 1-to-2, 1-to-3 risk reward, and that gives you the ability, but obviously you have to stick to that, right? There's a big how do you say it? I keep forgetting words now, man. Must be old age. There's a temptation to cut your trade when you're making money, to say, I want, I'm in the money, let's take the money and run. No, you have your target. You have to stop it only when things have changed, when something has happened and you are now thinking otherwise about the trade. So if you have a 2-to-1 or 3-to-1 ratio, if you stick to that and you choose wisely and you have a 50-50 hit rate, that's it, you're done. You're making money. So just to address that.
That's good advice. But what I would say about risk reward ratios is don't become beholden to them. Don't, I could say I'm going to risk 10 pips to make 200 on this trade. Okay, that's a great risk reward ratio, but what's my likelihood of achieving that? So you have to, risk reward is about, if I'm going to put money on this trade, what is my risk reward? What and you can use that by the levels. It's like I mentioned with dollar yen, trading this 140. Okay, my natural risk reward indicator in my brain was thinking, we're not dipping, we're sitting up around this 139, 70s, 80s. We keep coming back here. I'm going to try a big figure trade, but the price action is saying the chances are, if I get filled, we're going to get a break. And what happened? I got filled, and then we got a break. So in my head, I'm thinking, what's my risk ratio? I'm trying to trade scalp a big figure for maybe 20, 25 pips, but the price action is telling me we could blow through. So I'm going to put a 25 pip stop on, even though I'm initially looking for maybe 20 pips on the trade at the very worst. So that's a bad risk ratio. It's a negative risk reward ratio. But I'm happy to do that because I know how the market can react around these numbers. This is about knowledge and whatever. But you can't, don't put a trade on just because it's got a big risk reward. That's not the way to do it. You've got to be able to achieve a risk reward. So look at the trade in itself. If I short it here, where am I going to run into trouble? If I get into profit, like I'm saying here, where am I going to run into trouble? If I short 140, well, I'm probably going to run into trouble 139, 70, 75. So doesn't matter what my risk reward is. Doesn't matter if I want to get 138s, 136s. I need to worry about 139.70 first and foremost, and that's only 20 pips away. So, I could have a 3-to-1 risk reward idea. Doesn't mean I'm going to get it. Now, if there was no support around here or no prior resistance around here, and the nearest prior resistance and support was down here at 139, I could say, fine, I'm going to short 140. I think there's a good chance of getting the 139. Well, for me, 25, 30 pip, 5 pip stop, that's good risk reward. So you've got to take it in context of what the market levels are. As I say, no point saying I want a risk reward ratio of 4-to-1 if the chart's telling you, well, you might only get 2-to-1. So don't be beholden to your risk reward, but it's something you factor into your trading. Sorry, mate.
That's very absolutely right. And just another thing I want to answer. Our friend says, if I'm losing 40 pips on a trade with 30 pips target, how can I get 1-to-1 risk reward? Well, you can't. Risk reward, you don't set it after the trade's done. If you had a 1-to-1, you would have been stopped out at minus 30 pips if your target is 30 pips. Or if you were a 2-to-1, you would have been stopped out at minus 15. So you can't say, I'm down this much, I want to make it a 1-to-1. It doesn't make any sense. You put your levels at the beginning of your trade. Of course, you can adjust them at some point if things have changed enough. If something has changed in the fundamentals or in the way price action is going, yes, but your risk reward is set at the beginning.
Yeah, exactly. I'm happy to have a negative risk reward. I will happily trade for 10 pips and risk 20 if I have conviction to do that.
Absolutely.
Because, it's experience, put it that way. It's experience. You see price action, you trade something. Sometimes something is so clear, you've got to have a crack at it, even though it's crack risk reward, which is why. So I don't put too much faith in risk reward. Some people only trade if they've got decent risk reward, and I think that's wrong. But it is something you consider. It's not something to ignore, but it's not something you say, I will only trade based on this risk reward. This is the problem with trading. Okay, everything in trading is a contradiction. You can have one rule and then there's 5 contradictions to that rule. Yes, everyone should trade with good risk reward. Well, until X, Y, Z, or until this situation, or until that situation. You just have to, Stell says, have your plan at the start. And I say, you should start from one single point of your trading, not worrying about profit, worry about not losing. If you don't lose, the only other outcome is you make money, or at least you break even. That is it. Don't lose. If you can nail that, then you can now trade in, full stop. Right, let's have a look at a couple of other things. Dollar CAD hit the 136.50. This has been a bit of an area up here. Let's see if we can highlight that. This 136.50. So we're still moving between the goalposts. We had that move off of 133. It's got up to call it the middle of the range. Is a bit higher than the middle of the range, but again, we've hit one of those levels, old levels, as you can see, going back, support, resistance. Little bit of a move through, a little bit of a stick its nose above, but in the main it's held. This is still walking pretty well within the bigger context, as you can see here, this pattern we've got going on here. And this one does like to play nicely with the tech sometimes. I was thinking maybe we're going to move up through and maybe a test up there, but that's probably a bit fanciful to see that. But 136.50 is your boundary for now. If you're trading a loonie, obviously keep an eye on what's going on in oil, which had a little bit of a dip off again yesterday. But it's, what do you make of this stuff? I don't think we've seen it going sideways for so long, mate.
Well, the problem for me is not that it's going sideways; it's that it's going sideways with daily big daily swings. And I'm like, yeah, I'm not touching this shit. Sorry, I'm really not. I don't know what to make of it. I mean, theoretically, we should be going lower because of potential recession, because of demand kind of reducing. But OPEC is sitting around the corner saying, "Yeah, wait for you shorts. I'm going to squeeze you till you die." So I don't know what to do with it.
Yeah, it's becoming a bit messy down here at this 72 level, which, as you can see, was a bit of an area where we held as support and then held as resistance. So maybe we need to look at widening a bit the range that we might be seeing, maybe down to these lows. Still, the only 250 for me is the key level, and we've got this intra level 80 30s, 80 50s as well. But for me, I don't know. I'm like you. I don't know what it's doing down here at the moment. Based on the data, the manufacturing PMIs and the like, and what's been going on in China, I see no reason for this to bounce now. But it's stopped going down. So I don't know. We will have to see what comes out the data later on. And obviously we've got the messing around with OPEC and OPEC Plus and all that shenanigans. Right, I'm going to delete that off my charts. I think I don't want to look at that anymore. Right, have you boys and girls got anything else you want to dig into? And thank you very much for your comment, Ali, about today's lecture. That's what we try to do here, try and give off some of our experience so you guys and girls can learn from it. So I'm glad it's helping you guys and girls out. Where you can find us if you want to learn more. Only thing we got today is the PCE data from the US. Let's just take a quick peek at what's expected from that before we head off to the hills and the weekend.
And by the way, thank you everybody for all your nice comments. We really appreciate them and appreciate you being here, and it makes us want to become better and better. Sorry, carry on.
Amen, mate. Amen. So yeah, we've got the PCE stuff. And durable goods. So that's something to keep an eye on from the consumer side. So the core number is going to be important, expected in unchanged at 4.6%. PCE prior expected to come in a bit softer at 3.9% versus 4.2% prior. So pretty much like CPI, looking to do a similar thing. Look for a big variation in the numbers. There's two things. If both go up, or if the core goes up, that's going to be hawkish. If both come down, that's going to take away some expectations for a June hike from the Fed. Unless it's a real big change in the numbers, I'm not expecting any huge moves from it. We'll probably see similar to what we did over yesterday's GDP and jobless claims data there. But also keep an eye on that durable goods number because it is retail reflective on some components of that, because it deals with stuff like white goods and that sort of thing, computers, electronic equipment, so on and so forth. And that's that. Oh, no, it's not. We got the final numbers from the Michigan later. So, and again, just keep an eye on those inflation numbers, which expected to come in a little bit of a dip, but we could see them going high again as they did last month. Anyway, done. I'm done. It's the weekend. Go enjoy the rest of your days, folks. Remember, Friday's pips are beer pips. So if you've had a good week, think about shutting it down or dialing down your trading. Don't go and spoil it on a Friday. It is value day in the month, so watch the fixes later today. US bond markets on half day, so things in the States will quieten down. It's a bank holiday across a lot of the globe Monday. No shows from ForexAnalytix on Monday. Thank you very much, Stel, for all your input this week. Valued comments. Thanks to you guys and girls. Have a great weekend, everyone.
Thank you, Ryan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.